Hello, and welcome to our quarterly podcast on financial transactions and transfer pricing. During this podcast, we have a discussion with specialists of the PwC network on the latest developments. And my guests today are Dan Pybus, that's the person with the English accent. We have Bob Ritter with the American accents. And we have Ed Bagdasharian with the Australian accents. And I'm David Ledur, I'm the guy with the strange Belgian accents. So the topic today is the end of LIBOR. The topic is quite hot. As we will see later on, the deadlines are coming nearby. And while corporates should take into account many aspects to the end of LIBOR, like operational and system readiness, the discussion today will focus on tax and transfer pricing aspects. So Dan, if we take a step back, can you sketch what this end of LIBOR is? Why do you have it? What is it? When will it occur?
Yeah, sure. Thank you, David. So LIBOR has been long established as one of the primary benchmarks for setting term interest rates, and it's been used as a reference rate in a wide variety of arm's length intercompany agreements and external agreements. However, and you'll have heard some background, no doubt, in the marketplace about the cessation of LIBOR more generally, but on the 5th of March 2021, the Financial Conduct Authority announced the majority of LIBOR term rates will either cease to be provided by the administrator or will cease to be representative by the end of December 2021. Therefore, they're going to be replaced with a new benchmark risk-free rate for each of the relevant currencies.
Okay. And the old terminology was quite simple. You said the currency, then you say LIBOR, and then you say the maturity, like USD LIBOR 1 month. But it appears that the central banks or the regulators have put a marketing team in place to pick out new names. So can you provide some example of those names?
Yeah, of course. As you say, there's not one simple replacement, unfortunately, for LIBOR. So what we're seeing is a bit of a plethora of different replacement rates across the market. So in the UK, GBP LIBOR will be replaced with SONIA. In the US, will be replaced with SOFR, and a euro replaced with ESTA. So some different definitions to get used to. And it's similar across other currencies as well. There are similar replacement rates and new definitions to get used to.
Yep. Okay. So sometimes my wife asks me who's Sonia and Esther because I'm always talking about her. So the deadline is the 1st of Jan 2022. So that's more or less within 6 months. But I've heard there would be an exception for USD. So Bob, can you put this into context, please?
Yeah, thanks, David. So there was a LIBOR relief statement that was issued by the Fed on November 30th of 2020. A couple key points to mention from that is that while there's an extension on the publication of certain LIBOR tenors, and most of them will continue through June 30th of 2023, a couple of the LIBORs, the 1 week and the 2 week, will cease as of the end of this year, so as of December 31st, 2021. I think a couple important points to note as a result of that. I mean, why did they do this, right? And I think they did it to allow most legacy USD LIBOR contracts to mature, just to ensure there weren't any major experience of disruptions. A couple other points that new contracts entered into before December 31st, 2021 should utilize a reference rate other than LIBOR or have robust fallback language that includes a clearly defined alternative reference rate after the discontinuation. And another key point is that even though they have this a bit of relief, that any new contract that's entered into after December 31st, 2021, so 2022 and beyond, should utilize an alternative reference rate. And I think just importantly, and it was in the news within the last week, but there has been a view on the US side that banks aren't moving quickly enough to transition away from LIBOR. And so the regulators are pushing banks to try and do so more quickly. And so I think we'll probably see this trend and maybe more globally, but I know on the US side that's been some recent news that came out, and you'll see Janet Yellen in the news for that.
Okay, thank you. While the old LIBOR rates were quite similar in terms of characteristics, the new reference rate can be more diverse. Ed, can you explain some key difference between the old LIBOR rates and the new reference rates?
Sure, David. If you look at the new reference rates, they're a combination of either backward-looking or forward-looking curves, secured or unsecured. Some are overnight, some have broader term structures. And you really contrast that to LIBOR, which is a forward-looking term reference rate determined by a panel of banks, whereas the replacement rates are risk-free rates and, as mentioned, capture either forward or backward-looking curves determined by the market over a reference period. Now, the fact that these new reference rates, replacement rates, do not price in either bank credit risk or liquidity premium for term structure like LIBOR means that all things being equal, these rates will inherently be lower than the LIBOR rates today. So what is important is, in order to maintain like-for-like pricing, there needs to be credit adjustment spreads and other term structure liquidity spreads, which need to be embedded in these curves in order to make sure there's no shift in value upon conversion.
Okay, so credit risk and liquidity premium, these are some two important differences. I've also read that for some of the new reference rates, between them you might have some differences, and some are secured, some are auto secured. So also even there you can find some differences. So Bob, can you give a helicopter view on some tax or transfer pricing consequences of this conversion to the new reference rates?
Yeah, a couple things come to mind, David. One is just watch out for a change in the terms, including the yield. So as that spread is going to be different, can be a triggering event. So for those people familiar with the US, you can hear it sometimes called a 1001 event. And then depending on the magnitude of that change can result in a significant modification. And I'll talk a little bit more about that later in the podcast. And second, and importantly, you still need to price the revised margin over the new base rate. So, it's kind of putting this into context for people. If you had an all-in rate, which included a LIBOR base plus a certain spread, and price it at arm's length, then if you're going to do a transition and that base rate changes, then obviously if the spread were to stay the same, the all-in rate will vary. And so just things to consider as we're thinking about how that could change the overall yield.
Okay. Now, in general, tax authorities are quite silent on the topic, but I think IRS and HMRC, so US and UK, are the exception. They have published something. Bob, can you continue with what IRS mentioned on the end of LIBOR and the tax consequences?
Yeah, and I'll speak to the IRS side, and I think the UK is fairly similar in this view in the guidance. So in October 2019, the IRS issued guidance to assist with transition for LIBOR and the why. So this was issued because the ARC requested guidance from the Treasury Department on tax issues associated with elimination of, with the LIBORs and transition to other rates such as SOFR. So because the new reference rate is different from LIBORs, that they're intended to replace, it's expected that contracts will generally provide for a change in the spreads. Or a one-time change in value. And under U.S. tax rules, this can have very bad consequences, and this change in yield can result in what we call a significant modification, which can be a resulting taxable exchange of the debt instrument. So the guidance provided a list of potential qualified rates, including SOFR for USD, SONIA for GBP, and other sorts of currencies as a replacement. However, it has a couple things to consider. So the potential qualified rate is only qualified rate if the fair market value of the debt instrument is substantially equivalent before or after the modification. And so one thing to note is they do note the fair market value of the debt instrument may be determined by any reasonable quote unquote valuation method. There's a couple safe harbors that they have in there. And I think most importantly, since we're focused on transfer pricing, is that for related parties, there's a safe harbor with respect to the value equivalence requirement that it includes. And it's satisfied as the historic average of the rate is within 25 basis points of the rate that it was replacing. So I think just a couple of things to consider. So I think you kind of have to walk through the analysis and do some of those steps to kind of, as long as you do certain things, there should be a bit of relief for taxpayers, but you need to kind of go through each part of the analysis to make sure that you haven't tripped on a significant modification.
Okay, yeah, the safe harbor rate is an important one. I think that quite some countries have a safe harbor rates with reference to LIBOR, so that has to be monitored. So if we convert from the old LIBOR rate to the new overnight reference rate, we have to make a credit adjustment to the credit margin. So that's what X explained before. It's basically because the new reference rates have a lower credit risk and less liquidity risk. So in other words, if you had in the past GBP LIBOR plus 1%, for example, if you convert to SONIA, SONIA will be lower and you want to end up with more or less the same rates. The 1% have to be increased. Now, the new reference rates are new. There's not really a history of those new reference rates. So it's going to be difficult to quantify that today. Maybe within 5 years will be an easy one, but today you have a lack of information. So is that a fair statement, and how do you deal with that then?
Yeah, that's fair, David. I think there's a couple of things to factor in here. So if we look at the replacement rates, quite rightly, as you say, they're only starting to be used, particularly in the borrowing market and also the derivatives market as well. As that kind of use increases, we are going to be able to utilize those as benchmark sources going forward. But as the market currently looks, there's not sufficient information there to build the benchmarking reports and studies that we would need to create the analyses to support our intercompany rates. As a result, what you're left with is almost a couple of options. You either have to look at your existing credit margins and margins which exist over current LIBOR, and then utilize what you and Ed have alluded to earlier, which is your credit adjustment spreads. And there's various sources to look at there. You've got ISDA published credit adjustment spreads back in March when the announcement was made, but banks typically aren't utilizing those as the reference point, and so you have to look elsewhere. We have to look at different market sources or potentially calculate those credit adjustment spreads. So that's option one. Of course, as we get then towards next year, when the rates are being utilized, what we're also expecting to see is potentially synthesized curves and other information becoming available. So again, there's maybe an option there if you're looking to move away from your existing credit margins and not need to apply a credit adjustment spread. But there's not a great deal of that information yet, even in the synthetic markets. And so that's something we're going to have to watch for and adapt for over the next few months.
Okay. So basically, if you convert today, you should base that on market information, market practices today, which might be different within 1 year because the information will be different, but it's a matter of documenting your position today, and that is the best what you could do. So the new reference rates are only overnight rates, while the LIBOR, you had different terms. You had the overnight, we had the 1 day, 1 week, up to 12 months. So if you want to use a reference rate with a longer maturity is that still possible? And what are the solutions?
Sure, David. And as mentioned by Dan, there are various number of reference rates across different geographies, and it is changing with time. And there are a number of different solutions out there, depending on the data you have available, around really taking overnight rates and making them fit for purpose for the tenure you're looking at. So one common example is to take overnight rates and compound them to really replicate a longer term structure. But once again, I do stress that is one solution. And as a working group here at PwC, we've been thinking about other potential solutions which can achieve the same desired effect. At the same time, it is a moving target. There will be other potential sources in the market which will arise to replicate longer term structures. And at the same time, we know, just speaking to external stakeholders, that there are multiple reserve banks, financial institutions, and other similar working groups that are actively trying to come up with other working solutions as well. So the short story is it's not, one size fits all. Compounding overnight rates is an option, but it is very much watch this space.
Great. And maybe to continue with Duet, we hear a lot about the new reference rate for the European currencies and for USD, but less for other currencies and other regions. Is this actually a hot topic in Asia-Pac?
It is a hot topic, or it certainly is becoming a hot topic in Asia-Pac, David. And one of the functions of that is the reserves held by a lot of the financial institutions across Asia, which will be impacted by this change. So there definitely is a lot of focus. And you look across Asia's stance today, and there are quite a few different reference rates. And just to rattle off a few, the Bank of Japan has the toner rate, Bank of Thailand, the Thul rate, the Monetary Authority of Singapore has the SOR rate. And I can't leave any conversation not talking about Australia. We have the AONIA rate here as well. So I know Dan Snap mentioned a number of different reference rates outside of Asia, but we are getting similar traction across the region. And I expect very similar developments and thinking from an Asia Pacific perspective as well.
Okay, so a bunch of new acronyms also for that region. Okay, but that leads us to the end of the discussion. So thanks for your contributions. Maybe some takeaways I derive from the discussion. First one is groups normally should have a transition strategy already in place. As it's clear from this discussion, you should ensure that tax is around the table because there are quite some tax aspects to consider also here. A second one is for the credit adjustments. That's an important one. So you should have good supporting documentation for that quantification based on market information today. So when you make these actual adjustments. And as the market is in full development, this is something that should continue to be monitored, so to be always in line with the latest market information and market practices. And the last one is, if you have existing loan agreements in place, you should foresee some for transition, so what's called a fallback language. So with this, I want to thank again my two speakers as well as the listeners for checking in. And I also invite you to the new podcast, which will be recorded soon, and normally it should be on sustainable financing and transfer pricing. So thank you and see you soon.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.